Hi and welcome to this week's Property Insider video. Today Dr. Andrew Wilson and I discuss the new Victorian taxes slugging property owners. We're going to have a chat about the affordability situation for first home buyers and what the latest My Housing Market Index shows. It may not be exactly what you expect. And also we'll talk about what's happening to auction clearance rates, which seem to be falling a bit. If you want to keep up to date with what's happening in our property markets, please subscribe to our YouTube channel and click the little bell icon so you're kept up to date every time a new show comes out. Andrew's government has announced 3 new taxes targeting the property sector that have blindsided Victorian mum and dad property investors and the real estate industry that employs 1 in 4 Australians. It's the same sector that generates up to about 50% of the state taxes revenue. If Andrew's government has its way, this is going to make Victorians the most highly taxed community in Australia. I'm looking forward to getting leading housing economist Dr. Andrew Wilson's views on this, which happens to be the 9th new Victorian property tax announced by the Andrews Pallas administration. As I said, there's not much more capacity for any one sector to absorb a further tax burden. If Dan Andrews' intent is to drive investment to other Australian cities who are rolling out the red carpet for investment and are trying to create jobs, well, then this new tax is going to do that. In my opinion, we need to focus on creating more jobs and growing our economy, not penalising investment and increasing costs and risks. Also in today's Property Insider video, we're going to discuss housing affordability for first home buyers and the latest auction results. Welcome, Andrew.
Yes, thank you very much, Michael. And perhaps we shouldn't be surprised that the property sector has been the focus of the Victorian government in their upcoming budget. And obviously those measures are going to affect certain parts of the market. I'm not so sure that it's as broad as perhaps the longer term policy position of the New South Wales government, which is going to replace or seems to be going to replace stamp duty with a broad-based land tax for all homeowners. So that's the plan. So I guess this is more of a traditional hit on the market in terms of increasing revenue and focusing on obviously the higher end. But again, it is all about the deficit versus the income levels, and governments have to look to some areas to recoup what's been a big spend over the last 12 months.
Well, we'll go into that in a little bit of detail, but let's start as we usually do with the auction clearance results, because while they remain strong this weekend, it was the 3rd busiest auction weekend of the year, they have been falling a little bit, Andrew.
Yes, Michael. Interesting. The auction markets really are a window to the broader housing market energy, and I think we're clearly seeing the change in the market. As you said, the results are still certainly strong. They're very much in favour of sellers. We still have strong competition for available property from buyers. That is pushing prices upwards still and at strong rates. But nonetheless, we are starting to see, which is eminently predictable, an easing in our auction markets. We had another surge, as you mentioned, in auction numbers at the weekend. The weekend before, we had a record Saturday for May auction offerings. And although last weekend was just below those numbers, they were still significantly above what we typically see in May. So it's been a very big May for the numbers of properties coming into the market, Michael. Of course, the law of supply and demand says that more supply with a fixed demand puts downward pressure on those price outcomes or clearance rates particularly. And we're seeing that the Sydney clearance rate was down again, still very strong at over 80%. Melbourne had actually its lowest clearance rate of the year so far, but at 78%, still very much a strong result. Brisbane down a little bit as well. Canberra held up and Adelaide was down as well. But when we look at the national average Saturday auction clearance rates, we can clearly see the trend downwards now. And that's to be expected, particularly given the surge in properties coming into the market now. We've got to understand, Michael, a lot of buyers have been satisfied. We've had strong buyer activity. They've bought their properties. Now they're getting on with the business of living in them. So this is satisfying all that pent-up demand that we've had over the last 2 or 3 years, particularly given the COVID shutdown. And we are starting to see our markets moving back into more of a normalised environment, and more of a balance between buyers and sellers. But it's still got some months to run, Michael, before we get into that balanced position. And of course, we've only got 3 or 4 weeks till the start of the winter shutdown, which is, of course, the Queen's birthday weekend. And July is a bit of a non-event in auction markets and housing markets. as we work our way into the spring market. And, we're still going to have a good year in terms of activity in our housing markets, but we've certainly seen, I believe, the peak of the market, and that was the March quarter.
Well, the peak of the rise of the market, but not the peak in property values, I think, is what you're getting at.
Well, the peak in activity,
Yeah,
Michael, and
yeah.
property values have still got some way to run. I mean, we had over 5% in every capital cities and nearly a 10% growth rate in the March quarter results. We're not going to see that just stop. That will start to ease. These things just don't, unless we have catastrophic increase in interest rates, which isn't going to happen, or another shutdown. These things just will gradually rebase themselves and find their underlying level, which is what they've been trying to do for the last 3 years, Michael, except they've been interrupted by various bits and pieces. But we're now going to find that level, which we should have been at anyway, without those interruptions over the next 6 months. And then we just move on with continued price growth, but in a more moderate and sustainable way.
Well, that makes it a much healthier market, less likely for interference from outside government or authorities. Andrew, let's get back to what we were talking about a moment ago with regard to the Andrews government, who doesn't seem to like the concept of ugly, greedy Victorians owning investment properties. Now, sure, these new tax slugs are aimed at a certain segment of the property market, property owners who own more expensive properties, but they came in three rafts. There was land tax, which has been increased, and depending upon the value of your property, land tax could have even gone up 19%. More expensive properties, it's gone up 13%. There was also a slug on stamp duty, 18.2% increase in stamp duty on properties valued over $2 million. And let's be fair, that's not every property, of course, but it is still going to affect certain people. And there was that windfall tax, which would apply to rezoning of land. If I read that correctly, Andrew, what that's going to do is it's going to mean that a lot of the new estates that are being rezoned in regional Australia or in the outer suburbs are going to cost more. In fact, industry experts have been suggesting it could increase the cost per lot by $25,000.
Well, Michael, that adds to what we are going to see with increased building costs in those particular areas, that greenfield new home estate environment, because of the surge we're having in demand from the home builder program from the federal government, which, of course, as we discussed last week, has now been extended for first home buyers with another 10,000 places. So, know that there's going to be given this surge in demand, a shortage of labour and materials in the shorter term anyway, to be able to cater for this unprecedented surge in new development typically in those outer suburban new estate areas. So I guess the double whammy is if also land costs go up as well. So it's not just a supply on the construction, it's a supply on the land as well that'll be constrained in terms of the cost base. So that's, yes, when you've got a roaring market as you have in that new build market, particularly in Victoria, that can be absorbed in the shorter term with demand, particularly with the government support for that demand. The question is what comes after that. And when that demand is satisfied, higher prices will remain, particularly if they're coming from a tax position. It just means that those coming after those that have been fortunate enough to take advantage of A, lower prices, and B, government stimulus packages will have to pay a lot more, which means, it'll be tougher to get into that market. And it also puts pressure on the builders, the developers, the contractors, who will be really thinking about, let's make hay while the sun shines, because it might get a lot tougher when these good times are over, which they will be probably in the next 12 to 18 months.
Well, at the same time, those hard-slugging land taxes at higher levels of property ownership. But if you think about it, it applies to a lot of commercial properties and shopping centres. And the way leases work for commercial properties is those imposts are going to be passed on to the tenants, the small business owners. And how are they going to make money today? They've got to increase their charges, or they're going to have trouble as well. So this is going to flow on to the viability of tenancies. It's going to deter economic activity in Victoria, while other states are actually encouraging economic activity, Andrew.
Yeah, and it's inflationary as well, Michael. And not that we've got much to worry about in regard to inflation in the shorter term, but certainly it starts to work on inflation through the system. And of course, higher inflation becomes a problem if it does become sustained, and then obviously moves into how we're positioning our interest rates. The other point, of course, is that A number of those larger commercial buildings have suffered through COVID through a lack of tenants, commercial being not just retail, but also office.
Mm.
People have moved to the work from home environment. And even though that's normalising to some degree, surely there's got to be a cost to landlords in terms of less demand for their offices and therefore less capacity. And that is not taken into account for when they have to pay their, sort of higher taxes as well, pay a higher land tax as well, having a reduced income from their actual investment. So again, it's a cost situation where if it's passed on to the tenant, then the tenant will pass that on to the consumer. And again, it's a negative for economic growth, and it's not what we need right at the moment.
Well, at the same time, the Victorian Andrews government changed residential tenancies regulations a while ago. 130 changes that were in general favouring the tenants over what we were able to call landlords before, but now have to call residential residence providers. So I can imagine that some borderless investors, people who don't really care where they invest, are going to wonder, should I invest in Victoria? Should I invest elsewhere? I can't see local Victorian investors selling up. There's no sense in doing that. You're going to pay capital gains tax, you're going to pay stamp duty to buy elsewhere. But it may make people who are wondering, do I invest in Melbourne, Sydney, or Brisbane, or Perth, wonder, why should I bother?
Well, it's not just, I guess, the investment community, but it's also consumers, Michael. We've seen a definite migration out of Melbourne and Victoria to northern destinations, particularly Queensland. Latest ABS data, although it's September and backdated, showed a significant decline in net migration out of Victoria and a significant increase in Queensland, despite COVID. Now, we seem to have got a lot better control over COVID now, so perhaps the motivation to leave Victoria because of their severe potential for shutdowns is easing. But nonetheless, this is just another factor that just might swing more people into, as costs rise and job opportunities decline, and to think about that northern destination. And we're actually seeing that to some degree in interesting softening in vacancy rates for houses in Melbourne, which, although still reasonably tight, have just picked up or ticked up a point or two this year. And maybe that indicates that migration factor with less demand, certainly not coming in, but even declining demand from those existing tenants. And again, that's just a bit of a subset to what's happening in the bigger picture. And I'm not sure that significant property taxes are a way out of this. I can understand the government targeting the higher priced end of the market, and that's probably reasonably rationalised because it's a smaller sector. Stamp duty is passed on to some degree because typically the purchaser of your property has paid a stamp duty component in their property, which is then added notionally to the price of your property going forward. So it is part of the cost base of a house price. So in a sense there, it's fair because it's a discretionary tax in a way rather than a land tax, which everybody has to pay regardless of choice or circumstances. But one of the issues is that to justify this has been the saying about how Melbourne homeowners are having this windfall at the moment and therefore they can afford to pay it because of obviously booming house prices. But the reality is, Michael, that house prices have moved by around about 4% over the last 4 years in Melbourne. It's not like a windfall gain, it's just catching up to where they should be. And that's why the market's moving at the moment, because house prices have hardly moved over the last 4 years, despite cuts in interest rates and despite increases in income. So I think we've got to put that one into perspective. It's an impost and it is at the upper end of the market, but the capital gains at the moment really are just catching up to where they should have been. And that's why there's more upside to the market. But I think, as you said, also, there is a counterintuitive or rationale to this with the higher prices or the tax on higher home prices, because the federal government's trying to target downsizers, and that's the downsizer market. And that may be a disincentive for a downsizer to be moving on, or for them to be able to sell their property. Again, the justification is rational because of the spend that the Victorian government's had as a COVID response, and they're looking to property, which is obviously a significant part of their tax base, to try to recover some of what they've spent.
Can understand that. Let's turn our thoughts to the other end of the market rather than the more expensive properties, the first home buyers. There's always discussion about how affordable or isn't it for first home buyers. And I know your company, My Housing Market, has a first home buyer affordability index. What are you finding happening in that market?
Well, the latest March quarter index, Michael, not surprisingly, has shown the second consecutive quarter of declining in affordability. The proportion of incomes required for the typical housing loan is now increasing, which of course is a decline in affordability. All states recorded a decline in affordability over the March quarter, with the exception of New South Wales. But when we look at New South Wales in terms of its relative position, its relative affordability position, it's significantly higher than any of the other states. So it's the most unaffordable of any of the states. No surprise given how high that Sydney median house price is. But we shouldn't be surprised that this is a trend that's emerging, that first home buyers are now being pushed out of the market because prices are now pushing beyond their capacity, despite all the government stimulus support packages. And we are seeing more investors in the market, and they are also acting to crowd out first home buyer activity. This will continue, notwithstanding those policies that were introduced in the budget, which are very narrowly focused. I think we'll have a reduction. Of course, the affordability index, Michael, reflects what we're seeing with the ABS data anyway, which has also shown the last 2 months having a decline, and that's February and March, having a decline in first home buyer activity. So no surprises, high prices are pushing first home buyers out of the market. They've had a good run, and they're still at very strong levels. Let's not call it a doom and gloom, and they're still well above average levels. The trend is on, and by the end of the year or over the next year, Michael, I think we'll see around about a 30% reduction in first home buyer numbers nationally. That's what higher prices do.
But your chart at the moment that we're seeing shows that if you look back over the 15 years or so of this chart, even though affordability has become a little bit tighter over the last month or two, it's still much better than it's been over the long term.
Well, the market share for first home buyers, Michael, is above 20% at the moment. And the average long-term market share is just 14%. So they're well ahead of their long-term averages in terms of the share of the home loan market. So yes, it's declining. This is a reflection of very strong prices growth and the fact that we've satisfied a lot of demand from those first home buyers. And first home buyers don't have the trade-in to bring into the marketplace. They have to save their deposit, not use their existing home as a deposit, which would be rising in the same market. So it sort of swings and roundabouts there. So they obviously have issues when prices are rising as strongly as they are now in being able to keeping up with by saving their deposit from low income growth that we have at the moment. But we're still at the second highest level in terms of the number of first home buyers in the market on record. We have to go back to 2009, which was an unbelievable market then, courtesy of the Rudd government's first home buyer grant boost. Nonetheless, we will get back to, I think, around about 100,000 per year over the next year, Michael, which is around about the average level.
So there are a number of headwinds ahead for our property markets. Auction clearance rates are dropping a bit. Taxes are coming at us from all directions. First home buyers are finding it a bit more unaffordable. But overall, there's still more good signs than negative signs. Let's leave the property pessimists to keep having their arguments. And each week we'll have a talk about all the good things happening in the property markets, Andrew.
Yes, Mike, look, it's a stabilisation process. It's normalisation, it's stabilisation. We're at a very high level because we've had such low levels, and we're just making up for that. And now we're heading back to a more stable environment. And it's what we want to see without, as you said, the commentary saying that it's anything else other than an adjustment period. And that's what's happening now. We're adjusting, and we're adjusting well. And we're very fortunate to have at last a housing market that's free from all those outside destabilising influences.
Great. Well, look forward to chatting with you about our housing markets again next week, Andrew.
Thanks, Mike. See ya.